Okay, let's unpack this. If there's a poster child for AI infrastructure moonshots right now, in 2024, 2025, it might not be who you immediately think of. Forget Nvidia, forget OpenAI for just a second. Today, we're really digging into CoreWeave. Now, you might remember them, maybe vaguely, as an Ethereum mining collective, but wow, they've had this stunning transformation. Seriously, they're now one of the most aggressively growing AI infrastructure companies out there, anywhere in the world. Their playbook seems to be this rapid, almost like dizzying inorganic expansion. It's fast, it's flashy, and yeah, it's making investors salivate, while, frankly, regulators and credit analysts are starting to chew the nails a bit. So our mission here in this deep dive is to explore how CoreWeave's breakneck speed, this expansion, is unlocking some potentially huge long-term upside. But also, and this is critical, how it's pushing the company maybe closer to its risk ceiling than you might think.
Yeah, and to really get a handle on this, you need to understand what CoreWeave is, because they are pretty distinct. They're not your typical generalist cloud provider, like an AWS or Azure, not at all. CoreWeave is a specialized cloud provider. It's purpose-built, really, for AI, machine learning, visual effects, and also high-performance computing, HPC, which is essentially, supercomputing, but in the cloud.
Focused.
Exactly. Their entire focus is GPU-based cloud infrastructure, graphics processing units. That makes them a go-to for the massive workloads you get from things like large language models, generative video, that kind of stuff. And importantly, they boast one of the largest independent fleets of NVIDIA's really prized H100 GPUs.
That's the key hardware right now.
It absolutely is. So maybe think of it like this. It's a good analogy. If NVIDIA is the gold mine selling the hardware, CoreWeave is kind of like the pickaxe rental shop parked right next to it, and it's doing record business. So understanding this specific player, CoreWeave, is really, really key to grasping the whole AI infrastructure landscape right now.
That pickaxe rental analogy is great, yeah, spot on. And they've certainly been swinging those pickaxes like lightning fast. Their strategy, as our sources describe it, is like an inorganic blitz, just boom, boom, boom. We've seen them snapping up data center real estate like it's going out of style. Just in 2023, they secured or expanded operations in places like Plano, Texas, Odessa, Texas, New Jersey, even Sweden and the UK. But here's my question. Thinking about that speed, how much of this wasn't, building from scratch? How much was strategic acquisition or maybe leasing existing industrial sites or data infrastructure? And what does that actually mean for how fast they can deploy?
That's a really great distinction, and you've hit on a key point there. A significant chunk of this expansion wasn't greenfield. It wasn't building from the ground up. It was indeed, like you said, strategic acquisition or leasing of existing facilities, industrial buildings, existing data centers. And that is precisely what lets them deploy so much faster.
Okay. Makes sense.
Yeah, when you're dealing with, existing power grids, the cooling systems are maybe already there, the physical space is ready, you can get those valuable GPUs online much, much quicker than if you had to pour concrete first.
Right, skipping a huge step. And it's not just the buildings, the real estate, is it? They've also been super aggressive on the hardware side, securing the actual pickaxes.
Oh, absolutely. Beyond the physical footprint, you're right. They've locked in these multi-billion-dollar long-term contracts with Nvidia. For those H100s, the GH200s, the really high-demand stuff, that ensures they have a steady stream of the most sought-after chips, which is huge right now.
A massive advantage.
Huge. And we've also seen in demand contracts with some of the hyperscalers themselves, like Microsoft and OpenAI. In fact, some sources suggest CoreWeave actually became one of the primary infrastructure backends for ChatGPT for a while there. Apparently, Azure's own capacity started hitting its limits, and CoreWeave stepped in.
Wow. That's quite an endorsement.
It really is. Speaks volumes.
Okay, something else that really jumped out at me was the debt-fueled nature of this growth.
Yeah.
I mean, early 2024, CoreWeave raised just a whopping $7.5 billion in debt financing, backed by huge names, right? Blackstone, Carlyle. So tell me about this financing model. It seems kind of novel, being backed by the GPU hardware assets themselves. How is that reshaping what we thought was possible for scaling tech infrastructure? Are they like literally collateralizing their pickaxes?
That's a perfect way to put it, actually. Yes,
Yeah.
It's a genuinely novel twist in tech financing. And it really reflects just how valuable NVIDIA's gear has become. It's like digital gold. So unlike traditional debt that might be secured against, the company's general assets or maybe future revenue streams, this debt is specifically backed by their GPU hardware, the actual chips. It's a direct testament, really, to the perceived stability and, crucially, the demand for these high-performance chips. The lenders believe in that hardware value. And beyond that huge headline debt number, there are also credible rumors and some confirmed moves, too, of CoreWeave quietly acquiring smaller colocation providers, edge computing startups, little tuck-in acquisitions.
Okay, so expanding the network that way, too.
Exactly. It seems like a strategy to widen their network reach, maybe reduce latency for their AI clients who need things fast. At a very aggressive land grab, no doubt. But you could also argue it's a calculated bet on the future.
That's a powerful phrase, calculated bet. But I mean, who defines calculated in a market moving this fast? Are the long-term trends really as, locked in as they seem? Or are there maybe some underlying fragilities here that could disrupt this whole bet?
Well, it's calculated in the sense that this expansion isn't just, growth for growth's sake, or at least that's the argument. It's framed as a strategic wager on several big macro trends converging, trends that could create serious long-term upside if they play out. First, obviously, is just the AI workload explosion.
Right.
The global demand for compute power is, some estimates say it's doubling every 6 months. It's astronomical. And the traditional hyperscalers, your AWS, Azure, Google Cloud, they are genuinely struggling to keep up with that demand curve, especially for high-end GPUs. So CoreWeave, with its laser focus on GPU clouds, is kind of uniquely positioned to become what some are calling the anti-AWS of AI, the specialist.
And it's not just the overall demand, it's also scarcity, right?
Yeah.
Even the tech giants, the really wealthy ones, have apparently hit roadblocks securing enough of Nvidia's top-tier chips. CoreWeave seems to have this closer relationship with Nvidia, maybe preferential access, which you can imagine is a monumental advantage in a market this tight.
Absolutely. That relationship is gold.
Plus, they seem to be intentionally avoiding just being a commodity provider. They're specializing, targeting specific verticals, AI labs, animation studios, biotech firms trying to build loyalty with tailored solutions. But you mentioned something earlier about revenue predictability being rare for startups. How does CoreWeave manage that?
Right. That's another really compelling aspect here. The revenue visibility, those multi-year, multi-billion-dollar contracts we talked about with hyperscalers and big LLM developers, they give CoreWeave this incredible predictability in their revenue streams. For the next few years, at least.
Which must help with financing, I imagine.
Exactly. It's not just about stability day to day. It fundamentally shifts their perceived risk profile for lenders and investors. It potentially lets them access capital and scale in ways that, typical cash-burning startups can only dream of. It kind of de-risks a segment of this hyper-growth AI market, at least on paper. And then, for that ultimate long-term upside, of course, there's IPO buzz. CoreWeave confidentially filed for an IPO, reportedly aiming for mid-2025. The goal is clearly to raise billions more, probably to refinance some of that debt we mentioned, maybe fuel more growth, and really cement their role as a major GPU infrastructure player. If that IPO is successful, getting access to public market capital could really reduce their financial stress and, unlock a whole new phase of growth.
But, okay, here's the rub, right? That same inorganic growth, that blitz, it can also be really hard to digest properly. It makes me wonder if CoreWeave might be reaching a point where the sheer bulk is outweighing the muscle, where the risk limits are getting uncomfortably tight. That $7.5 billion debt raise, for example, yes, it was hyped as brilliant asset-backed financing, but it's still debt, a lot of debt. And unlike the hyperscalers who have these massive, diverse cash flows, our sources indicate CoreWeave is still cash flow negative overall.
Still burning cash.
So if GPU resale prices were to fall sharply, or maybe if AI demand softens even a little bit, couldn't the company be left holding a very, very expensive bag of depreciating assets? Is there a genuine concern that this rapid expansion could actually turn into a huge liability rather than an asset?
I think that's the core tension, absolutely. And it raises a really important question about concentration risk. CoreWeave's biggest customers, people like Microsoft, OpenAI, they apparently represent a really disproportionate chunk of their total revenue.
The big whale problem.
Exactly. If they were to lose one of those key clients for whatever reason, or even if overall AI demand just dips slightly, maybe due to new regulations throttling things, or maybe efficiency breakthroughs mean less compute is needed, that whole house of cards could start to wobble pretty quickly. Then there's the critical issue you touched on. Hardware obsolescence. It's huge in this space. GPUs are fundamentally depreciating assets. Fast. Today's cutting-edge H100s could realistically become tomorrow's, maybe not paperweights, but significantly less valuable quite quickly, especially if Nvidia or maybe AMD launch significantly better, more efficient chips in 2026 or 2027, which seems likely.
Right, the tech cycle is relentless.
It is. So CoreWeave's current fleet, that multi-billion-dollar asset base, could lose value faster than their depreciation schedules account for. Especially if the resale market for used GPUs dries up, if nobody wants the old H100s anymore. It's almost like buying a fleet of top-tier Formula One cars today, knowing that next year they might release personal jets that are faster.
That's a stark, but yeah, probably accurate analogy. How do they even mitigate that kind of inherent risk?
Yeah.
Especially with such a massive hardware investment tied up in it.
It's incredibly difficult. You rely on locking in customer contracts that hopefully outlast the peak value of the hardware. You try to manage your depreciation aggressively, but it's tough.
And let's not forget the IPO timing risk itself. The IPO could be a huge win, like you said, refinancing debt, getting cash. Or it could be a faceplant. If the market sentiment cools on AI infrastructure stocks, maybe because of some of these risks we're talking about. Or if debt markets just tighten up generally, CoreWeave's IPO could underdeliver on valuation, or maybe even get delayed. And that would put further strain on their balance sheet right when they need the cash.
Precisely. Timing is everything with ITOs, especially for companies with this kind of profile.
And then there's the whole layer of geopolitical and regulatory uncertainty floating around too. Export controls on advanced chips, U.S.-China trade tensions, rising calls for greener, carbon-neutral data centers. These all add external risks you can't easily control. CoreWeave's footprint in Europe and potentially Asia might give it an edge in some ways, diversifying geographically, or, it could just turn into a regulatory minefield depending on how rules evolve in different regions.
Yeah, it really feels like if you connect all these dots, CoreWeave is sitting at a fascinating strategic fork in the road right now, a real decision point. They could, option one, just double down on more expansion, keep the foot on the gas, betting on basically uninterrupted AI growth for another 5-10 years.
The high-risk, high-reward path.
Exactly. Or option two, they could start to slow their roll a bit, pivot towards optimizing the infrastructure they already have, focus on increasing their EBITDA margins, that's earnings before interest, taxes, depreciation, amortization, basically operational profitability, become more efficient.
More sustainable, perhaps.
Potentially. Or option three, they might even pivot more into services, start offering things like AI orchestration software, model hosting platforms, performance monitoring tools, moving a bit closer to the software side of the stack, which often has higher margins than pure infrastructure rental.
Yeah.
Their inorganic growth strategy has clearly worked spectacularly well to get them to this point, to this scale. But sustainability, proving the long-term economic model, that's definitely the next big test for them.
So what does this all mean for you, the listener, and anyone watching this really dynamic space? I mean, it seems clear CoreWeave is a kind of go fast or go broke moonshot. It really is. It's powered by leverage, incredibly precise timing so far, and riding this white-hot wave of AI compute demand. But this is not a slow burn compounding story like a Microsoft or even Nvidia itself. It feels very different. It's a vital experiment in the market, absolutely fascinating to watch, but it's really important to remember. It's definitely not bulletproof.
Right. And looking ahead, I think it's crucial to maybe identify some specific metrics that you should watch really closely if you want to track CoreWeave's future trajectory. Keep an eye on their GPU depreciation schedule. How quickly are they actually writing down the value of those expensive assets on their books? Monitor their customer concentration. Are they managing to diversify their client base beyond just a few huge players? That would reduce risk. Pay attention to their debt maturity ladder. When do those big chunks of debt come due? Can they refinance? Okay. Look at their utilization rates, how much of their expensive infrastructure is actually being used, and for what kinds of workloads. Is it consistently high?
All good indicators of health.
Definitely. Also, obviously, watch for the actual IPO filing details when they become public, the valuation they seek, who the underwriters are. That tells you a lot about market confidence. And finally, keep an eye on any regulatory signals, either around AI compute access generally, or specifically around data center emissions and power usage. These metrics, taken together, will give us clues about which of, say, 3 plausible scenarios CoreWeave might be heading towards by maybe 2026.
Okay, lay them out for us. What are the possible futures?
Well, you could have the bullish scenario. Let's call it GPU Goldman Sachs. In this outcome, CoreWeave pulls off a successful IPO, they refinance that debt smoothly, and they really leverage their scale and Nvidia relationship to dominate the specialized AI compute market. Big win.
Okay, the dream scenario for them.
Then there's the base case, maybe call it survive and optimize. Here, they have a perhaps more moderate IPO. Growth slows down a bit, becomes more focused on efficiency, consolidating their gains, improving profitability. They survive and stabilize.
More of a grind, but still viable.
Right. And then, of course, there's the bearish scenario, the GPU graveyard. In this future, maybe hardware values crash faster than expected, the IPO gets delayed or flops, default risk on that massive debt load rises significantly, and that could potentially lead to painful outcomes like asset fire sales or maybe even an equity wipeout for early investors if things go really wrong.
Wow. It really is quite the spectrum of possibilities, isn't it? From market dominance to, well, graveyard. The long-term upside potential is clearly real huge even. But man, only for those who can stomach the potential volatility and risk along the way. So, as you consider these scenarios, what aspect of CoreWeave's story really stands out most to you? Is it the sheer speed of the growth, the maybe inherent risks of this kind of debt-fueled moonshot, or perhaps just the sheer audacity of building an entire empire on the back of a single, highly specialized, rapidly evolving asset class like GPUs? Whatever it is that grabs you, well, buckle up. This cloud definitely looks like it's got some thunder ahead.